You're watching Market Sense. We've got Shyam Srinivasan, Managing Director and CEO at Federal Bank, now joining us on the show to talk to us about the bank's plans going forward. Shyam, to begin with, could you take us through the first quarter performance of Federal and also take us through what the key growth drivers for the bank have been?
Q1 from an operating profit point of view was okay. We delivered 30% profit over like quarter last year. There are 3-4 things that went well for us. Our savings growth was quite encouraging. We grew almost 40% on an annualized basis on savings, which is something that we take heart from because a lot of our expansion and our initiatives are beginning to bear fruit. 2 was gold loan business continues to steam ahead, and that's an area of focus for us. 3, important is the overall credit cost is something that we were able to bring down considerably, and we believe that these are the 3 things that went well. Overall deposit growth was very good. We ran down a significant part of our bulk deposits. Our advances didn't keep pace with our average deposit growth, but that was by choice because we didn't want to expand into major credit risks in a time when environment is fairly volatile. So on balance it was okay. We are facing some challenges around the overall portfolio wherever there is leverage, and we are watching that closely. But financially it was a good outcome.
Afternoon, Mr. Srinivasan. If you could talk about your net interest margins, where do you see them headed, and are you going to see a little bit of pressure coming in?
Our guidance for the year is about 360, our net interest margin. Q1 was slightly lower because of some quarter-specific events, and we believe for the financial year FY13, we should be in the 3.6 or thereabouts net interest margin. We've always guided that between net interest margin and overall reduction of credit cost, we wanted to be in a blended space of risk-adjusted margin close to 3%. And that's our journey, and I think we are tracking reasonably okay for that.
And Shyam, what are your targets for credit and deposit growth for the year? Are you seeing any signs of corporate credit appetite rising?
The credit target for the bank, we had set ourselves in the beginning of the year around 20 to 22%. I think it may be on the lower side, closer to 20. We have seen demand on the overall credit increase, very specific. Working capital demands are increasing, particularly in the mid and SME sector. Retail credit, particularly gold loan, has been quite good, and we see that continuing. Large corporate, big investment, project finance has not yet taken off, except for fulfilling earlier sanctions. We haven't seen big new projects coming up. There are occasional requests which are really short-termish in nature, that there is still credit demands in the market, but those are very short-term. Really big projects I haven't seen, but working capital requirements from existing clients continues to be reasonably healthy.
Now, the bank has opened quite a few branches over the past few months. How many do you plan to open by the end of this year, and how has this impacted your costs?
We are at 999 branch as we speak today. On the 17th of this month, we open our 1000th branch. That would be about 250, little more than 250 branches in the last 13 months. And that's quite substantial. We see the momentum. We have demonstrated to ourselves the ability to open. But we will be a little more cautious about how many more branches in this calendar year, only because I want to make sure that what we've opened are delivering value and we are holding on to the promises that we have made to ourselves. From a cost point of view, we've been quite careful about it. We haven't blown our costs very materially, and you will see our cost income continues to hold quite well. In fact, sequentially, some of our operational expenses actually improved. So I don't see costs becoming a major challenge, but we want to make sure that the value that is coming through this cost continues so that we can continue to invest. So this financial year, we do have a plan of another 100, 150 branches after crossing 1000, but that will be more back-ended because I want to see the value coming in up until December and then only take the next call.
Shyam, also give us a sense of your gold loan business, because the RBI has cracked down on gold loan NBFCs, which actually has benefited banks like yours, which are big players in that space.
Long before RBI intervened with the NBFCs, we've been focusing on gold loan as a segment, and we've had good progress. In the last 18 odd months, we've grown this business over 100%. If you take the Q1 rate, incrementally we grew quite substantially. And I see that as an opportunity. That the NBFCs are a little more distracted probably helps, but we've actually, through the enhanced franchise and our historical strengths with existing customers, gold loan is a natural fit for us. So I think gold loan growth will continue. If NBFCs have challenges, it will be a plus for us, and I think both combined will see us grow very healthily on the gold loan side.
And if you could just give us a sense of the interest rate scenario going forward, has the recent cut in SLR by the RBI given you any headroom to cut rates?
See, the most recent cut in SLR for a bank of our size gives me only 500-600 crores of excess liquidity. So it's really not a big driver of wanting to cut rates. Partly it will be competition led. We'll have to watch how the overall scenario plays out. But I think the interest rate scenario, as RBI has guided very frequently, they are, very sensitive about inflation. Unless there are signs that inflation is cooling down, I don't see interest rates coming down in a hurry. And if that doesn't come down, rates may not come down quite sharply. There may be some symbolism, some tokenism, 25-50 basis points cuts coming, but not substantively is where I see at least this financial year. And therefore, I don't see rates dramatically falling.
And lastly, Shyam, do you have any fundraising plans for the year? How much incremental capital would you need to meet Basel III requirements?
We are very well capitalized. If you see, we have 15 point something in terms of our CRAR, and bulk of it is tier 1. So we've looked at the Basel III criteria, and we are very well capitalized. I don't see the need to raise capital at least till FY14.
Shyam Srinivasan, thanks very much for joining us on the show with your outlook for the Federal Bank's growth outlook going forward. We're going to take a very quick break then on market sense, but when we come back, we focus on Brent crude, which has surged above $113 a barrel on renewed fears of supply disruption from Iran, which in turn is exerting pressure on the rupee and even bond yields right here in India. So how should you be positioning yourselves here on? We've got Jayesh Mehta of Bank of America Merrill Lynch who will be joining us on the show with his views on the outlook for the currency and fixed income markets.